Hello and welcome. This is Jason Ulrich with Top Shelf Traders. Thank you for joining us. It's great to have you here. It's noon on the East Coast, and we have a number of folks that are filtering in as we speak. We were just sorting out a little bit of a technical difficulty with the audio, so I'll just do a quick sound and visual check. If you could just let me know that you can hear me okay and that you can see the screen okay, that would be great. Go ahead and put that in the questions box, and we'll go ahead and get underway. All good? Love it. Great.
Excellent.
We'll go ahead and get started here. We know it's the lunch hour. It's our pleasure to have Matt Clark with us today. Matt is with InvestmentWatch UK. He is a financial services veteran. He's done just about everything, ranging from reports for clients' pensions and investments all the way through to actually being a stockbroker. And Matt is going to be talking with us today about profitable trading tips that you can use. Now, we're going to be talking and looking at specifically today stocks, Forex, and crypto. And a few things that we're going to hope to come away with: what's going on with the stock market, some of the fundamentals of trading, what it's like and what you should be looking for as a currency or a Forex trader, and then the popular topic of cryptocurrency. So when we had the chance to have Matt join us today, we jumped at it. He's based in the UK, so it is late afternoon, early evening, his time there. As always, this is going to be an interactive session, so as you have questions, please don't hesitate to ask them. We'll go ahead and monitor the questions box as they come up, and we'll be sure to pause as we can. Any questions that we can't get to during this phone call, we'll go ahead, or this presentation, we'll make sure that we follow up. And as always, this session is being recorded, so we'll go ahead and post this to our channel and send it out afterwards. So, Matt, thank you for joining us. It's great to have you.
Great
By
to
all
be here,
means,
Jason. Thank you.
of course, I'll turn it over to you. Take it away.
Perfect. Thanks, Jason. Well, everyone who's listening, we're InvestmentWatch UK, and we're going to have a bit of a talk about the stock market, the Forex market, and what it involves in being a trader, and also the very popular cryptocurrency market. So as I say, the agenda, we'll be looking at the economic and political situation globally at the minute. Obviously, there are a number of things going on affecting the markets. We will look at the stock market and how they've performed recently over the past 12 months, and perhaps some things that we've got our eye on moving forwards. Forex trading, as I say, what it takes to become a trader, some certain things that are worth noting for yourselves moving forwards. Cryptocurrency, it's in the news all the time at the minute. It's a big talking point in the financial market sector. So we're going to look into what is cryptocurrency, how people are making money from it, and whether the bubble will burst or it's here for the long run. And we'll also have a bit of information on what we do at InvestmentWatch UK. So, start with the economic and political situation. What better place to start than with Mr. Trump? I mean, whether you believe he's in rightly or wrongly, whether you agree with his actions or not, he's certainly come in with a lot of bravado, a lot of front, and certainly hasn't held back with his views. I mean, if you're looking at just purely from the markets are flying. The Dow Jones is hitting record highs. So is that on the basis of what Donald Trump said, what his policies are? Or is that an underlying issue in the strength of the economy, regardless of Donald Trump? Personally, we believe that the market is due a pull-off. With the way Donald Trump is, it's almost irresponsible how he's going forward with these policies. As I say, we won't get into political talk about Donald Trump because we could be here for hours upon hours. But it's certainly causing interest in the market with what he says. You can see that the market reacts sometimes with a bit of nervousness and uncertainty when he goes to talk. And we'll move on to the next one, which is probably the biggest one at the minute, with the missiles with North Korea. Now, I was actually reading a report the other day that is the issue between the US and North Korea just a testosterone-filled argument between two men who won't back down and are too stubborn, or is there more to it? Now, the tensions with the US and North Korea, how long is it going to continue? Will one of them back down? Will they reach an agreement? That remains to be seen. Over in North Korea, they are saying that they're doing testing for their missiles. If it was to continue, obviously, it could have catastrophic ramifications for the global economy and the world itself if these nuclear missiles were to be let off. Whether they will or not, as I said, remains to be seen. But if it was to happen, who knows what could happen to the markets and the economy. I suppose in terms of the markets, you could look at gold and commodities being the safe haven that they are. There's a potential investment there as the investors will flock to the safe havens, and therefore their prices will rise. There's potential talk of cryptocurrencies like Bitcoin becoming a safe haven like gold, which we will come on to later on. But I'd certainly expect to see a rise in the price of commodities if the market was to start to shake as things developed. If it wasn't to happen, I believe it would be good for the markets if there was an agreement of some form. Again, how easy that will be between those two remains to be seen. But if it wasn't to happen, it's good for the markets because it ends uncertainty. You're not going to have the talk of will there be a missile strike, will there be a world war. If it's ended, the agreement has been made, both parties have drawn a line in the sand and moved on. The uncertainty is over. If there's one thing that the market doesn't like, it's uncertainty. So that would be reflected in the markets. In terms of the markets, actually going back to if it was to happen, I did mention the commodities and the safe havens of them. You potentially look at the defence companies. Over here in the UK, there's one called Babcock International. If you've got a company that's supplying the military, it's obviously not a nice way for them to be doing their business, but hey, supply and demand, so there's potential there. But generally, in terms of investments, you've got to be looking at the commodity sector for that. Over here, obviously in the UK, we've had the Brexit referendum last year. There are talks, there's been talks going on even today about whether there would actually be a no deal for the Brexit and whether the UK does remain part of the EU. The no deal would potentially be awful news for the UK. Again, for the simple fact that the UK public have voted to leave the EU, but then the no deal has been done. And again, as I've just mentioned about the uncertainty, it just leaves the whole thing in a bit of a mess, to be honest. So, it's going to get to a point where even the people who are anti-Brexit, they just want it sorted. So it'll end the uncertainty. As I said, lack of uncertainty could see the market steady out and be on their way and upwards motion. Will it affect the UK strength on the global table? I'm not so sure it would affect it because the UK is a strong economy in its own right. Obviously, it does benefit from good trade agreements with the EU, but I don't believe that there are reports that the UK could be hung out to dry, maybe. But I personally have the opinion that the UK strength on the global table wouldn't be affected. Would it affect the large UK-based corporations around the UK? EasyJet, the budget airline over here, they're perhaps the biggest one, who have said that they will look to leave their UK base. And to be honest, I genuinely don't believe that many companies will, because again, the UK is still a great place to be. The economy is holding out. I'd say we're one of global strongholds. So there's all the talk around the Brexit, and still ongoing to a degree, of companies leaving the UK. But I'm of the opinion that they won't, purely because the logistics of it is going to cost billions and billions, and it just doesn't make business sense to do so. Now, we'll have a look at the stock market, so we'll just have a quick whiz onto the platform here. So if we just go on to this. So, as I mentioned, we've had the rise to record highs. So, we've got here on the platform, I'll just get rid of these. So, we've got the Dow Jones here. I mean, we've got the chart going back to mid-2014, but you can see the rise all the way across through to where we are now. Is there going to be a pullback at some point? You think so. As I mentioned, a lot of it is dependent on how Donald Trump how he goes about his policies, especially with North Korea. I mean, the US economy appears to be going okay, but whether I don't believe, as I said, that is a result of Trump. I think that's just the case of the economy itself. So, yeah, I mean, the UK, the US has gone to record highs, and I mean, again, it's a very, very similar pattern that we're looking at here. Again, the FTSE 100 just flying. We had calls a few months ago that 7,000 was a bit of a ceiling. Gone through that, and we're just over 7,500 now. So, how far is it going to go? There's industry experts struggling to call a ceiling. So, I mean, again, you can see in this area here that there's a massive room for a pullback. Can we get a square on here? So, I mean, if you look around here, around the 6,500 mark, there's great room for a pullback there. Whether it's obviously not going to fall off a cliff, but there's the potential for a pullback there. So, I mean, we've rose to record high. Why? I mean, it's particularly an interesting one because we left the EU, and that was meant to be the bad news, worse news for the economy, etc. And we did drop off initially. I mean, just get the mouse, so you can see here, we dropped off this week at the end of June, but then straight away shot back up and we've kept going. Why is this? Now, the pound sterling is correlated directly to the FTSE 100. The pound has capitulated record lows almost against the dollar, euro, etc. Now, a weak pound benefits the FTSE because the FTSE 100 companies are massive exporters. So the massive exporters, a low pound is excellent news because obviously the foreign companies will be purchasing their goods. So, a weak pound correlates well with the FTSE, but how long the pound will stay weak for remains to be seen. I believe it started to show a bit of support, so I believe it will start to steadily increase, which as a result you could anticipate the FTSE coming down over the coming 6 to 12 months, back down this way. So that's something to definitely keep our eye on. And so let's go back to the presentation. Oh, bear with me 1 second. So the stock market is an impending crash. Now, obviously, we had the issue of 10 years ago with the global recession and the subprime lending, which caused devastation across America and the global economy. I am firmly of the opinion, and I've had this opinion backed by a number of universities in the UK and a number of financial institutes, that we are on the verge, maybe in the next 12 to 24 months, of a crash that is going to be even bigger than the one of 10 years ago. What is this crash all about? As you can see there, credit cards, MasterCards, whatever you want to call them, the bad news. Now, I mean, if you look over in the UK, we've got record low interest rates, and there have been for some time now, as a knock-on of the global recession of 10 years ago. Now, your banks, your financial institutions are lending money out at a ridiculously high rate. So people have been getting mortgages, credit cards, loans, payday loans on interest rates that some of them, I think actually one yesterday, 300% per annum. Now, people are being missold these, and they don't know, they're just seeing the short-term gain of getting a loan of, let's just say, for £10,000, and it's payable of £20 a week, which isn't much, but when it's payable over the next 10 years and that £10,000 costs them just under £50,000, there's massive, it's going to be massive, this crash. Mortgage and debt repayments, people are living on a strict budget at the minute. There has been talk that in the next 6 months interest rates are going to start to rise, and what is going to happen from that is people are not going to be able to afford the repayments because wages aren't going up in line with that. I mean, I've seen a stat last week that in the UK we are living off 118.6% of income. So that 18.6% of income is coming through your credit cards and loans, but they have to be paid back at some point. Now, this is going to be a big crash because it's going to affect every single person, and I believe the knock-on effect globally will cause it to be a bigger crash than the recession of 10 years ago. The banks, especially, I know the same over in America and the UK, have lost a lot of trust. There has been the mis-selling of payment protection insurance. Now the banks have started giving out these debts. They've done a magical thing a couple of decades ago by changing our debt into credit. So credit is good. So if people have a credit card, that's good news. Well, in fact, now it's bad news. People are using these credit cards left, right and centre, and they're not aware of the consequences because there is a lack of financial education globally. So as I go back to the charts we just shown, I believe there will be a massive pullback, and there will be a global crash. It's not to do with the political and economic situations we've just looked at, purely on the basis of those plastic things there, the credit cards, and that's all going to come to a fall in the next 12 to 24 months. Now, on a brighter note, let's look at the potential joy of a penny stock when you trade in the stock market. Penny stocks, they've had a bit of a bad name, I suppose, over the last few years, because you've got your films like The Wolf of Wall Street, etc., where you get a call and this company is going to be the next big thing, but it's actually somebody in the garage. So they've had a bit of a bad run, but penny stocks, if you do your research, do your due diligence, that can be great investments. I mean, don't get me wrong, they're penny stocks for a reason. They're small, new companies that are just getting going. And I mean, if you can hold on to the coattails and get the right company and it goes, then the returns you're looking at are phenomenal. I mean, there's one here that I like the look of, and I have had my eye on for just under 12 months now. It's called EVR Holdings over in the UK. Now, this is a penny stock. It's trading at around 8p at the minute. And it's, I mean, as you can see, going back to July last year, it was sub pennies. And what they do is on the virtual reality headsets that you see for computer games, etc., they provide the software for that, and they have a number of large contracts in place with some of the big hitters in that industry. So if that's so, why is it still down at the level it is? There's been talk, I mean, if you want to go and buy one of these, it's going to cost you a lot of money. What we're looking at is your PlayStations, your Xboxes, your games consoles. Once that the price gets lowered and it becomes the next household gadget for people to have in the games consoles to use, the price is lowered, but the uptake on it, the demand, that will go through the roof. There has been talk of analysts looking at a £1.50 price target. I mean, if you're getting into it now at around 8p, if you buy 10,000 shares and it goes up to £1.50, you've made nearly a 2,000% ROI on that. Now, that's not a bad amount of money to be making. Obviously, the thing with penny stocks is it is a lot more likely to go to zero. But like I say, if you do due diligence, this one, in my eyes, is a good one. If you can get the right one, there's a potential massive return on investment, because the way you got to look at it, all big firms were small at one point. your Apples of the world, let's say, even going back a few decades ago, they were a small company. So if you just do your research, trade what you know, trade the sector. I mean, Warren Buffett, the most successful investor of all time, he doesn't invest in tech. Why doesn't he invest in tech? Because he doesn't understand it. So, okay, there's a lot of money being made in tech stocks, but just the understanding, you have to understand what you're investing in. So we're going to go back onto the platform again now. So, 1 second. So this part, we're going to be looking at the technical side of the trading. By the way, we have no affiliation with this company. It's just a platform that I find easy to use. So this one we're going to be looking at now. So this company, Ocado Group, they're in the UK retail sector. Now, I rather picked Ocado because this is an excellent example of how to trade technically. Now, the two yellow lines that you can see are there and there, a support, which is the lower one, and a resistance, which is a higher one. Now, if you're going to simply trade on a technical basis and look at these, so the bottom yellow line, if you can spot a trend of where it bounces roughly around here, so, okay, it did drop just below there, but let's just say every time it hit this yellow line, you bought the stock. So there's one time there, so you got 1, 2, and 3. Now that is there. If you bought 3 times there, that is brilliant, because you can see bounce off there. There's a level of support at that level. So again, your investors, I mean, it's almost at the exact times in a month. So there's a level of support there. So on a technical basis, you keep buying there, and then you can spot here, here, and here. So that's where you're looking to sell. I'll bring that down. So you bring those down, and that is a simple trade. You buy there at just under 280.5, and you sell at 310.35, and that is all you do: buy and sell, buy and sell. So if you look for these trends, that is a great way to make some money by actively trading your accounts. So known as range trading. So that is a perfect range to be trading there. I mean, so what you could anticipate here is that eventually that will come back down to this level. So again, that could be a great reason to pick the stock up there, and again, sell it when you get to that level. On a technical basis, it's just worth adding that if it was going to go and break and come up, let's just say it's around here, and it's broke that level, then as it goes through to here, you might not be looking to sell, as it's broke that level of resistance, so it could keep going up and up. I did mention earlier about the FTSE 100. There's talk of a resistance of 7,000. It broke through that and it's kept going. So once it breaks through that resistance, there's a potential there for the trade just to keep flying. But again, these are things actively managing your accounts. This is how you can make money. Excuse me. Now, one thing I would add, in stock trading, fundamentals always override technicals, because let's just look at this here now. That is perfect, really is perfect. But if you're coming to, let's just say this part here, this arrow is, turn that round. That there is a perfect short trade there, and if you bought there, you can sell there, perfect. But let's just say here, for example, there's some news coming out from Ocado Group that they're going to have their quarterly statement come out. So would you be looking to place a short there? Would you be looking to close the trade? You could potentially be looking to sell your trade that you put in here, but you definitely be looking to minimise your risk by putting a stop loss in, perhaps just below here. Why? Because fundamentals will always override a technical. It could look the best trade ever on a chart, But if a bit of news breaks out, that will be focused on by investors more than the charts. So you could be looking there, thinking I'm going to be selling here and maybe putting a short on. It's reached the top of the range. But if they've got some news coming that's forecasted to be good, it could be you could be looking at having a price target around here. So that carries on going up. Let's get a line here. Goes from there, it keeps going up and up. There, it's had a great few days. You just missed out on that opportunity. However, there is the downside to that. So, as I say, the most important thing of trading is risk management. So you simply put your stop loss in there, let's just say. So, okay, you may be missing out on the profit of this bit here, but you bought it there, so that's still a good level of profit. But you're locking in the profit just in case it does rise up to there. So that's a bit about technical trading. How it's not easy. I'm not going to say it's easy, but it's very simple if you follow the methods. So when you're looking at the charts, look for support and resistance. But it's always worth noting the importance of the fundamentals overriding the technicals. So we'll get back onto this. Sorry about this, I'm not sure what's doing this. So time cost averaging. This is a massive one for me. This is something I've always done. I always encourage investors to do. This is how time cost averaging works. If you've got $10,000 to put into an investment, instead of putting a lump sum in one go, stagger that. Regular contributions are key. I say this to all my clients. Regular contributions are the most important thing in your account, along with managing your risk. We'll show you this now. So this is a company called Barrett Development, who over in the UK are a house builder. Now, you can just see, just here on the edge, the blue arrow. So we're buying here, each blue arrow is the first of each month, from June to August. June 2016 to August of this year. So you have $10,000 or pounds. Instead of putting the £10,000 all in there, you split it across, and you do your regular contributions of $1,000 or about £800, let's say $800. So this one's been a great example that we've traded. So if you bought the lump sum of the shares over here, the day before this drop here was at the Brexit referendum. So if you bought the shares there, down to here, you've had a 40% drop. I mean, if you go over to August here, your shares will be, in comparison to this here, your shares are 8.22% up, which isn't a bad trade for a year, to be fair. However, as I said, you've had this drop, you'd have been 40% down at one point. So a lot of people would be thinking that they've messed up, it's a bad trade, cut your losses. Now, obviously, depending on your attitude to risk, you may just think, I've had enough, cut my losses. However, if you stay disciplined and have your regular contributions, a drop is almost a good thing. That drop there would have been brilliant, because you know if it comes back up, it doesn't even have to reach the heights of this. If it comes back up to around this level, you're in a good level of profit. So just across the year of having an equal monthly contribution, in comparison to being 8.22% up with the lump sum, you're actually 18.22% up. And with this stock, you have a 2% dividend yield as well. So just by splitting your one-off lump sum across regular contributions, that shows that your profits can be greater, but also it minimises the risk, because patience, don't get me wrong, this could have stayed around here and gone like that and been very slow. This was quite a rapid rise up, but it's great for managing risk, because if you bought there 40% down and it did stay there, you're holding a huge loss. But if you keep buying and buying and buying at these low levels, your average price lowers. If your average price lowers, that is great news for you, because you're going to get into profit a lot quicker than if you had the lump sum. So that is something that, if you're going to take anything away, along with the risk management, the we'll go through later, this is the one. So we have a bit of a look at Forex trading now over here in the UK, and I believe in the States it's really, really popular now. Why is it really popular? I mean, over the past decade, Forex trading has become the thing to do. Everyone would download their apps on their phones or have go on their PCs and the Macs, have a bit of a go on trading, trade the markets. Why is that? It's because, I mean, I've got that picture there. You're probably wondering what that picture is about. It's people looking to escape the rat race. People hating the journey to work, the idea of being chained to a desk or building sites, wherever it may be, for 40, 50 hours a week, and in just about enough money to go back to work the next day. People are looking for something else, something that they can be in control of. And with the way technology is, as I say, with the apps and everything, Forex trading has become a very popular way for people to build a second income up or look to change their career path. So with the Forex trading, a lot of people say, "Oh gosh, no, I'll be no good at that. That's too technical for me." But there's an argument, nature versus nurture. It's a very common discussion and argument over here in the UK. In the field of sports, so your soccer players, your athletes, were they born with that ability, or is it something that they've built up after hours upon hours, years upon years of practicing in the gym, in the training ground, and developing their skills and attributes? Trading is exactly the same. So nobody's born a good trader. You don't all of a sudden pick a computer up and start making profitable trades. Well, if you do, that's more luck rather than judgment. But as I say, you can't be born a good trader. It's a set of skills that you've developed from continuous hard work, continuous practice, the discipline to stick to your methods, and the discipline to keeping your trade sizes the right amount for you. Initially, there will be losses that are made, but again, risk management, if you stick to the risk management principles that you implement, then you take the short-term pain for long-term gain, and you nurture yourself into becoming a natural trader. You don't just wake up. Nobody wakes up one day and snap of a button becomes an excellent trader. So, as I said, with the pound cost averaging, that was something important to take away. Now, this is the one other thing that I'd perhaps say as well. The risk to reward. You never, ever, ever should risk more than you're looking to make in profits. So, for example, if you're placing a trade and you're putting 10% of your account value at risk, you should be looking to make at least 10% profit. You should never, ever go below that risk to reward of 1-to-1. I mean, I always look around a 2-to-1 risk to reward. So if I'm risking, I do 5% personally. I risk 5% of my account value. I'm looking to make 10% profit in that trade. That's a good way, because don't get me wrong, we don't get every trade right. But then for every 2 trades we get wrong, we only need 1 to go right. And then you find that your account does build because you do end up making more correct trades than incorrect trades. A question I frequently ask is, what size of trade is the size to start with? I mean, I have mentioned 10% and 5% there. I always say to people, beginners, use 1% of your account. Why 1%? Because it's low risk and you're not going to make a fortune initially, but in your initial trading as a beginner is all about risk management, not losing your money, but developing your knowledge and experience. So doing the 1%, you have to get 100 trades on the bounce wrong to blow your account out. Is that going to happen? No. You will get some right along the way. And especially if you do the risk to reward of 2-to-1, you're gonna make a couple of percent here and there. Another thing I'd say is to never ever use a demo account. Why not? A demo account, okay, it's good for looking at charts like we've just done, etc. However, it's a completely different ball game psychologically. You're going to open a demo account with $10,000 in. you lose $3,000 this afternoon, you're not too fussed because it's make-believe money. But if you stick $200 of your own money in, then all of a sudden it becomes a lot more real. So I always say to people, open up a live account, even if you just put $100 in there, build your experience up, and then going back to the pound cost averaging of regular contributions, every month put in, even if it's $20 a month, build that account up slowly, and then all of a sudden in a couple of years' time, you could be looking at a very healthy account, but it has to be started with a live account initially. So, I mean, I did mention a technical element of trading with that the Ocado stock, the support and resistance there. Forex trading is a lot more technical based than stocks. Why is this? The stock market closed. I mean, over here in the UK, the stock market's been closed now for over an hour. So overnight, the stock market can't be traded. Whereas the Forex market is 24/7, 5 days a week. There's a lot more liquidity in the market. You're not buying a physical asset. So if you go and buy stock, if you're buying it, someone has to be selling it to you. You have to have that matched up. Whereas the Forex, there are no buyers and sellers to be matched up because, let's say, you're not buying a physical asset. It's very technical, but I still stick with the mantra of fundamentals overriding technicals. So if you are a Forex trader or you're looking to get into Forex trading, I would definitely make note of not try to avoid trading on a news day. So I know over in the US you have the non-farm payroll day. So any Friday that's on, you avoid trading the US dollar. Now, don't get me wrong, you can make a good amount of money there because the markets are very volatile on news days. As you have investors speculating against rumours before the release, and then after the data release, after that has happened, then people will be reacting, and it's a mad scramble. So I just sit back, watch the charts if you want, but I'd always look to pretty much avoid trading on news days. So now we're going to look at the world of cryptocurrency. Cryptocurrency has come to the fore, especially over the last maybe 6 months or so. Since Bitcoin has been shooting through the roof. So with the cryptocurrency, what is cryptocurrency? It hasn't come from the central banks or anything. It's decentralized form of electronic money. It's anonymous. There's hundreds and hundreds of cryptocurrencies out there. Obviously, the main one is Bitcoin. What is that picture, you may be thinking? That picture is a mine. Now, it's not a mine that you may be familiar with in terms of your gold mines, your silver mines digging. This is a cryptocurrency mine. So the mining comes from a server. So to mine Bitcoin, Ethereum, Litecoin, etc., it has to be mined. So these computer servers, it was on Bloomberg recently, a group of Chinese investors had bought 10 fields the size of a field the size of 10 football fields, that's right, in Zambia, in Africa. And what they've done is build warehouse units and just filled them with computer servers 20 foot high. And all these servers individually were working on an algorithm, trying to crack a code. And every so often they'd get a code, and that would create a Bitcoin. Now, this is out of the league, too advanced for people to have in their own domestic homes because, well, to be honest, it would probably blow the house up. But that is where they are generated from. And then you have your wallet. Now, this isn't a wallet that you can put in your back pocket and carry in your jeans or in your bag. Your wallet is on your phone, your PC, whatever it may be. But the thing to note of interest with these is you get an authentication code, your ID key. Whereas if you go log onto your emails after this presentation, let's say you forgot your password, you can click forgot password. With this, if you forget your code, you can't get that back. So you could have millions of Bitcoin or whatever crypto it may be that you're invested in. If you lose that code, it disappears forever. So it is always worth, if you have done investments in cryptocurrency, making sure that you've got hold of that code. This is a chart of Bitcoin from today. It has dropped off a bit. I've done this just to show how volatile it can be. I mean, the economist Robert Shiller has come out today saying that he thinks Bitcoin is a fad and it's just going to peter out, the bubble will burst. Now, that has caused the price of Bitcoin to drop over 3%. You're not going to find a day where Bitcoin is ticking over at 0.01% here or there. It is very volatile. Why has it risen so much over the past, well, you could go year, 2 years, or even like a couple of months? Supply and demand. You look at the charts recently, as it's been more in the public domain, people talking about it. You had JP Morgan CEO talking about it the other week, which, funnily enough, he stated that it's a load of rubbish. To be fair, it's just a bubble, which caused the price to drop. And then, funnily enough, a couple of days later, JP Morgan bought up thousands of Bitcoin. Make of that what you will. But supply and demand, as with the stock market, supply and demand is the main factor. The more people that will think this is going to go far and shoot up, the more it will shoot up. Simple. It's simple as. So, will it continue to rise? Perhaps so. Perhaps so. As long as the demand is there, it will continue to fly. I mean, we hit a record high on Friday of 5,856. I have seen reports of 10,000. I have seen reports of 100,000. So he's going to go high, but the one thing to be wary of is the pyramid schemes in cryptocurrency. Now, there are lots and lots of these schemes around. The one in particular in the UK is called OneCoin. So how to spot these pyramid/Ponzi schemes? I mean, as you can see from this chart, this picture here, pyramid schemes are unsustainable because you start with 6 people at the top, they all get 6 to 36, and then, as you can see, down to the 11th level, it gets ridiculous. It's unsustainable. So be very, very careful about these Ponzi schemes. So how do you spot them? They have recruitment drives. They have seminars in hotels. It's a bit alarming, to be fair. I mean, with OneCoin, they're being investigated. So again, as with your penny stocks and any investment you do due diligence, do your checks, your research. The first alarm bell should be ringing if there's no white paper. A white paper is pretty much their instruction guide on what they do and how they're going to go about doing it. If there is no white paper, you don't even go any further. Completely disregard it. As I say, if you see cryptocurrency doing recruitment drives to get people to sign up, let's just be honest here. You don't need to be doing recruitment drives. If the product is good, it speaks for itself. And also closed circuits. What I mean by closed circuits is you put your money in, but you can't get your money out. A lot of these Ponzi schemes and pyramid schemes, they promise you if you invest $10,000 today, it will get listed on an exchange in a year's time, and that $10,000 will be worth $250,000. Rubbish. Stay well clear of them. So that's how to spot the Ponzi schemes and pyramid schemes. So regulation is a massive, massive thing in cryptocurrency. Would the lack of regulation pop the bubble in cryptocurrency? South Korea and China put massive restrictions into place for cryptocurrencies because it's an anonymous transaction. Will it ever become accepted in Western civilization where the US, the UK, European markets ever have Bitcoin and other cryptocurrencies as a recognised payment? remains to be seen because the banks and financial institutions don't like it as they lose the power. The currency isn't in their hands. It's not centrally backed. So will the bubble of cryptocurrency burst? I personally have the opinion that it will continue to rise. We may be looking at a bubble, a good one. We won't have time to talk about it today, but we have done a report that's on our site on the tulip mania that was in the Netherlands a few centuries back, when people just realised that maybe it isn't worth that much. Will it get to that level of Bitcoin? Perhaps so, but as I said, supply and demand, as long as the demand is there, it will keep on rising. So a bit of a summary of what we do at InvestmentWatch UK. The whole company is based on a monthly subscription service. We offer a weekly watch list for your Forex trading, your stock trading, and your cryptocurrency. We provide ad hoc trading tips, which normally around 4 a week. So obviously, sometimes there's more, sometimes there's less. We do a Sunday supplement news roundup, a few pages on what's happening globally in the world and affecting the different markets. We send out educational reports. I hold regular Q&A sessions with analysts and traders, and that costs us £35 a month. So here's a few examples. So the subscribers that we have on the Forex, they have on the left, they have the trading tips and signals. Importantly, obviously you've got your levels and entry and stop loss, but you've also got the reason why we're placing the trade, so you can build your understanding up. And on the right hand side, there's an example of one of our educational reports on what to do if the trades are going against you, see on the chart how it may be played, etc. These are examples of the stock report. So this is one we've done on dividends. So if you're looking to make a portfolio that's got a lot of dividends paying into it, those are the best stocks in the UK to have. And then also that's a stock-specific report that we've done recently for a firm in the UK that had dropped off significantly, and what our thoughts were on that. And this is the cryptocurrency weekly bulletin that we actually sent out start of this week. It's a 4-page documentation. It's just obviously a snapshot of the top of the first page, but that goes through the analysis, the industry, and also some potential trading tips we're looking at. So thank you for your time. Looking forward to any questions. Thank you.
Thank you very much, Matt. Very much appreciated. And one question that came through that we were curious about, you covered a lot of the recent events that have taken place over the course of the last few days, with the S&P being where it's at and really showing no signs of backing off, at least as of current levels right now. What are your suggestions for traders that are dealing with all-time highs that are just have one eye out for things to completely turn over and fall apart and start plummeting? What do you watch for, and what are some of the early indicators that you're looking for?
So with regards to early indicators, I mean, I've mentioned news days and data releases. So I always personally, and we recommend it to our clients and subscribers, keep your eye on what's coming over the next few weeks in terms of data. I mean, if there was a shock one-off event, then there is nothing you can do about that. But I believe, I mentioned about the crash that I'm anticipating, and it has been widely backed over the next 12 to 24 months. You look through the news, you can see things starting to slip. So more and more bad data releases coming through, bad reports from the big companies, and they explain there might be lack of consumer confidence, etc. So it's just a case of reading between the lines in the data releases. You'll see the market could start to wobble. A bit of bad data comes out. As I've mentioned, investors don't like uncertainty, so some investors, your institutional investors, may just look to pull the money out of the market and take the profit, and that's when you can see the market start to turn. So in terms of keeping your one eye on what is to come, it's just a case of the data releases, the company's updates. If there's So, for example, a company might have reported record profits, but if they're anticipating profits to drop off in the future, if the companies, etc., are looking nervously forward, that's your time to start thinking about coming out of your positions.
Got it. Okay, very fair. One other question just about the service and the subscription. So what is the cancellation policy? Can someone try it? Is there a trial offer? And apologies if you already covered this, Matt. I just want to make sure I field all the questions here.
No, sure. So, I mean, any people who've watched today's webinar, they get a free 1-month service. They go onto the site, they complete the application page, so we have their details, but they don't complete the payment page, then they'll get the month free. Once people are paying, there is no contractual period. If you decide today at 1 o'clock you don't like it, you don't want to be paying anymore, then you don't pay anything further to that. There's no tying in period or anything. The moment you decide to cancel is the moment you don't pay anymore.
That's great. Okay, fantastic. Matt, do you have a link that you'd like us to put in the box? And just for those that have joined us here today, we'll also include this in the follow-up email as well. But I just want to make sure that if you want us to include something, we have it. You can put it in the chat box here, and I'm happy to do it too if you want me to.
Yeah, sure. So, bear with me a second. I'll just get that across. So. Yeah, that's the page for our subscription services. Details there, what the different packages are, and then they can click through there to get started with us.
Perfect. I'm just putting this in. Outstanding. Matt, thank you very much for joining us. It was great to have you. Awesome presentation. Of course. We will publish a recording of this. We will also send a follow-up note to everyone that attended, and then, of course, the recording to everyone that registered but may not have been able to make it. And thank you again for joining us. Look for future Top Shelf events. We've got another 2 events scheduled for the coming week, and it's basically filled all the way through early mid-November. So plenty of great content on the way. So thanks again, Matt. We'll be in touch with you. And sorry, Matt, go ahead.
Thanks a lot. Thank you. No, say thank you for having me. It's been a pleasure.
Very good. Thank you. All right, everyone. Those of you that are looking to get back to your lunch or grab a sandwich, we'll let you go, and have a great rest of the day. Okay.
Thanks.